Welcome to this explainer. Look, if you've been paying any attention to the crypto futures markets lately, you might think the wild price swings and massive trader losses are just, the result of bad luck or natural market cycles. But today we're diving into the hard algorithmic truth. The crypto market is not just some volatile trading floor. It actually operates as a highly calculated machine, mathematically designed to trap the crowd. We're going to uncover the harsh reality of how this system is truly engineered behind the scenes.
You really have to look at the sheer scale of the wealth transfer happening right under our noses. According to data from Kraken, in 2025 alone, total crypto liquidations exceeded $150 billion. I mean, let that number really sink in for a second. $150 billion. This isn't just a collection of poor trading decisions, guys. This is a systematic harvest. It's a highly efficient machine built to extract capital from retail traders who actually think they're playing a fair game.
To put that into perspective, we're looking at a daily carnage averaging $400 to $500 million wiped out every single day. $500 million forcefully taken from traders' accounts day in and day out. As someone who loves to break down complex systems, I find the efficiency of this absolutely staggering. But as traders, you have to understand that this daily extraction is literally the lifeblood of the futures machine. It's an algorithmic hunt, and unfortunately, everyday retail traders are the prey.
Okay, let's get into Section 1, the double-edged leverage trap, the illusion of control.
Now, to understand the hunt, you really have to understand the bait. Traders willingly step right into this system, completely lured in by the illusion of leverage. So here's exactly how the trap gets set. Kraken outlines this perfectly when comparing spot trading to leverage trading. In spot trading, you know the drill. If you have $1,000, you buy exactly $1,000 worth of coins. If the price tanks, well, you still hold those coins. End of story. But in leverage trading, that same $1,000 is just your margin. It lets you open this massive position. It feels like control, right? It feels like this incredible shortcut to wealth. But it is a profoundly dangerous instrument. Because if the value of that leveraged position drops, the exchange can, and absolutely will, forcefully close it, wiping out your entire $1,000 in a flash.
And the trigger for that forced closure? It's something called the maintenance margin. This is the exact mathematical line in the sand. It's the absolute minimum amount of funds required to keep your leverage position alive. When your funds drop below this exact line, even for a split second, the exchange's algorithm just takes over. It forcefully closes the position and strips you of your allocated margin. You don't get a polite phone call warning you, you just lose your money instantly.
Moving on to Section 2, the hidden math, inside the exchange algorithms.
We're going to look directly at Binance's internal documentation to expose the mechanical nature of this whole system. This is where the true whistleblower reality comes to light. Just look at the seemingly harmless quote from their own docs. The funding rate will equal 0.01%. Sounds tiny, right? Well, this is the hidden rate trap. Binance calculates what they call a premium index. As long as that index sits in a specific narrow band between negative 0.04% and positive 0.06%, the system literally defaults to extracting a fixed 0.01% fee from retail traders, and they do this generally every 8 hours. So the absolute crucial takeaway here is that even when the market is relatively quiet, the machine is still slowly bleeding the crowd through these automatic fixed interest deductions.
And this brilliantly illustrates just how deep these calculations really go. We're not just talking about a simple flat percentage here. Exchanges use incredibly complex order book data. They calculate the exact impact bid price and impact ask price across multiple levels, measuring base quantities against accumulated quote notation. Okay, actually, scratch the jargon. In simple terms, they scan the entire depth of the market to calculate exactly how much volume it takes to manipulate the price and force convergence between the perpetual contract and the actual spot price. This proves, without a doubt, that liquidations are not random accidents. They are deeply calculated algorithmic moves executed by the exchange's own internal math.
The real key to that math is the impact margin notional, or IMN. Exchanges use this highly specific formula, taking 200 USDT and dividing it by the initial margin rate at the maximum leverage level just to locate the average impact price in the order book. So why does this actually matter to you? Because it shows that the exchange knows exactly how much volume is needed to move the price and trigger a massive cascade of liquidations. It is a highly mathematical hunt, and trust me, the algorithms always know exactly where your maintenance margin is hiding.
All right, Section 3, volatility as market fuel, triggering the mathematical trap.
So, if the algorithms are the engine, extreme volatility
is absolutely the fuel that makes this machine run at maximum speed. Let's look at how real-world events are essentially weaponized against the retail trader. Recently, we saw U.S. airstrikes on an Iranian military site near the Strait of Hormuz. Strictly acting as a geopolitical catalyst, this news hit the wires and just immediately ignited the market. Within minutes, Bitcoin dropped below $73,000, and in the immediate aftermath, nearly $1 billion in leveraged positions were completely wiped out. The exchanges didn't care about the news itself, the algorithm simply saw the extreme price movement as the perfect opportunity to harvest $1 billion.
This is exactly how exchanges use extreme volatility to liquidate the portfolios of retail traders. The geopolitical news triggers massive price swings. Those sudden drops, like that brutal flash crash below 73K, force prices violently through retail maintenance margin levels. But here is literally the most chilling part, found right in the Binance documentation. Under these quote-unquote extreme market conditions, the exchange reserves the right to actually change the rules on you mid-game. They can shrink the funding fee intervals from every 8 hours down to every 1 hour. This rapidly accelerates the drain on your margin, making it even easier for the algorithm to initiate those forced closures. They tighten the noose right when you are at your most vulnerable.
Finally, Section 4, Trade Like a Hunter, Surviving the Market.
Now that we've exposed the machinery, how do you actually survive this? Well, you have to stop trading like the prey and start trading like a hunter. Based on some very actionable advice from Kraken, here is your survival guide, and you really need to apply this urgently. Step 1. Use a stop loss, and crucially, set it long before your liquidation level. Do not let the exchange's algorithm decide when you exit a trade. Step 2. Monitor your positions incredibly closely, especially during times of geopolitical unrest. And Step 3. Use leverage intentionally. Lower the leverage you're using and open much smaller position sizes. This gives your trades the vital breathing room they need, keeping your liquidation price far, far away from your actual entry point.
Which brings us to the ultimate question you have to ask yourself every single time you open a leveraged futures position. Are you the hunter, operating with strict risk management and logic, or are you simply the market's fuel, serving as margin just to feed the $150 billion liquidation machine? You've got to understand the math, understand the algorithms, and protect your capital at all costs. Thanks for joining me on this explainer.